Welcome everyone to Imperium Forex educational webinar. My name is Rob Clayton. In today's session I shall be talking about 10 most important rules of technical trading. Before we begin, I would like to make a note that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. So what are the 10 most important rules of technical trading? Identify the trends. Find the trend and go with it. Find the lows and highs. Know how far to retrace your steps. Draw the line, follow the trend. Moving averages are followers, not leaders. Learn the moves with the oscillators. Know the warning signs. Is it a trend or not a trend? Identify the confirming signs. Identify the trends, the primary, then the secondary. Start by looking at monthly and weekly charts. A broader scale of the market movements will offer more visibility and a better understanding of the long-term pattern. Primary. The primary trend is the major trend of the market, which makes it the most important one to determine, which can last up to a year or so. Secondary. Primary trend is the main direction in which the market is moving. However, the secondary trend can move in the opposite direction of the primary trend or a short-term correction to the primary trend and can last only a few months, out to 3 to 6. Once you have established a pattern, then you should refer to the daily and intraday charts. A short-term or intraday view alone can often be misleading if you don't have the right tools to identify the trends. You will, however, do better if you trading in the same direction as the intermediate and longer term trends. Find the trend and go with it. Determine the trend and follow it. Market trends come in many phases: long-term, intermediate and short-term. Once you decide and identify the one you are going to trade, use the appropriate chart, as in time frame. Make sure from the broader to the short term that you are trading the right direction of that trend. Look for any potential pullback, as in buying the dip if the trend is up, or sell into strength if the market rallies, if the overall trend is down. Trading from a long-term perspective, look for the intermediate trend by the use of the daily and weekly charts. Intraday traders should use either the daily or intraday charts, that being to a 4 or 1 hour time frame. But in each case, let the broader time frame determine the trend, and then use the shorter term viewing for timing. Find the low and high. Finding the support and resistance levels. Finding the most suitable place to buy a market is identifying the support levels. Finding the support by viewing the previous reaction low or trough. Finding the most suitable place to sell a market is identifying the resistance levels by viewing the previous peaks. After a resistance peak has been broken, it will usually provide you the support on subsequent pullbacks. Specifically, the previous high becomes the new low. In the same way, when a support level has been broken, it will usually produce selling on subsequent rallies. The prior low can turn out to be the new high. Know how far to retrace your steps. Measure percentage retracements. Market corrections can either be up or down, usually retrace a significant segment of the previous trend. You can measure any correction in an existing trend in simple percentages. A 50% retracement of a prior trend is most common. A minimum retracement is usually 1/3 of the prior trend. The maximum retracement is usually 2/3. Fibonacci retracements of 38% and 62 are also worth watching. During a pullback in an uptrend, Therefore, initial buying points are in the 33 to 38 retracement area. Draw the line, follow the trend. So trend lines are one of the most easiest and most useful charting tools. A trend line is a straight line that connects two or more price points and then extends into the future to act as a line of support or resistance. Uptrend lines are drawn along two or more successive lows, and the downtrend are drawn along two or more successive peaks. Prices will often pull back or rally to trend lines before resuming their direction or trend. The breaking of the trend lines usually signals a change in trend. A valid trend line should be touched at least 3 times. The longer a trend line has been in effect and the more times it has been tested, the more important it becomes. Moving averages are followers, not leaders. Moving averages can be used in any time period. However, the moving average is a follower, not a leader, as it never anticipates, it only reacts. Moving averages can assess in the trend direction. It is the oldest form of technical analysis and still remains one of the most commonly used indicators. Unfortunately, moving averages don't work for all assets, especially for those in very volatile industries or those that are heavily influenced by current events. A combination chart of 2 moving averages is the most popular way of finding trading signals. Some popular future combinations are 4 and 9-day moving averages, 9 and 18-day, and 5 to 20-day. Signals are given when the shorter average line crosses the longer. Price crossing above and below a 40-day moving average also provides good trading signals. Learn the moves with the oscillators. Oscillators are used to discover short-term overbought and oversold conditions in a market. 2 of the most popular oscillators are the Relative Strength Index, the RSI, and the Stochastic Oscillator. They both work on a scale of 0 to 100. With the RSI, readings over 70 are overbought, while readings below 30 are oversold. The overbought and oversold values for stochastic are 80 and 20. Most traders use 14 days or weeks for a stochastic and either 9 or 14 days or weeks for an RSI. Using an RSI, prices can remain overbought or oversold for a long period of time, so do take note of that. Oscillator divergence often warn of market turns. These tools work best in a trading market range. Weekly signals can be used as filters on daily signals. Daily signals can be used as filters for intraday charts. Know the warning signs. The MACD indicator is a leader. One of the most popular technical indicators used in the market is the Moving Average Convergence Divergence, MACD indicator, which was developed first by Gerard Appel in 1979. Then in 1986, Thomas Asprey added the MACD histogram, which measures the distance between MACD and its signal line. Like MACD, the MACD histogram is also an oscillator that fluctuates above and below the 0 line. The purpose of the MACD indicator is to show changes in the strength, momentum, and direction of the current market. The MACD turns 2 trend indicators, an exponential moving average into momentum oscillator. As a result, the MACD offers the best of both worlds, a trend following a momentum. The MACD fluctuates above and below the 0 line as the moving averages converge, cross, and diverge. Because the MACD is unlimited, it is not particularly useful for identifying overbought and oversold levels. Is it a trend or not a trend? Use the ADX indicator. The ADX indicator measures how strong a trend is. The average directional index, or ADX, minus directional indicator, minus DI, and a plus directional indicator, plus DI, represents a group of directional movements indicators that form a trading system developed by J. Wells Wilder. The directional movement index, ADX, line determines whether a market is in a trending or a trading phase. It measures the degree of trend or direction in the market. A rising ADX line suggests the presence of a strong trend. A falling ADX line suggests the trading market is absent of a trend. The two other elements to the ADX indicator are the directional movement, plus DM, and minus directional movement, minus DM. When plus DM is above minus DM, trend is up. When minus DM is above plus DM, trend is down. Identifying the confirming signs. Don't ignore volume. Volume is a very important confirming indicator. Volume precedes price. It's important to ensure that heavier volume is taking place in the direction of a prevailing trend. Rising volume confirms that new demand is supporting the prevailing trend. Declining volume is often a warning that the trend is near completion. A solid price uptrend should always be accompanied by rising volume. Lack of confirmation may warn of a reversal. So what are the types of the volume indicators? A volume oscillator records volume only. On-balance volume compares closing price and volume. Accumulation distribution, or money flow index, compares closing price, range, and volume. To end this educational webinar, I like to just say, keep to the basics, and from a past quote, technical analysis is a skill that improves with experience and study. Always be a student and keep learning. So this brings an end to my webinar. Thank you very much for joining me. I hope you find this presentation useful to your trading. So from myself and Imperium Forex, would like to thank you for your attention and joining me to this educational webinar.